Hello financial fans, welcome back to another stock analysis. Today we'll be looking at Campbell Soup Company, stock ticker CPB. Campbell Soup Company is a company that does food processing and packaging, famous for their soups. Currently they're sitting at a market cap of almost $17 billion, and in 2022 they generated a revenue of $8.56 billion. Their dividend yield is currently 2.61%. Campbell's are focused heavily on two divisions, Campbell Snacks and Campbell's Meals and Beverages. Some of the brands from Campbell Snacks include Pepperidge Farm, Lance, Snyder's, and Late July. Campbell's Meals and Beverage includes some brands like Campbell's Soup, Swanson, Base, and SpaghettiOs. 46% of their revenue is generated from the Campbell Snacks department, and 54% of the revenue is generated by Campbell's Meals and Beverages. Looking at revenue by region, 79% of the revenue is generated in the USA, 8% in Australia, and 13% in other regions. To determine the value of Campbell's, we'll be using a margin of safety at the end of our calculation. This margin of safety will be determined based on financial ratios and the financial health. We'll be using a standard margin of safety of 25%. Adjusting this margin of safety, we'll be using a scale. When we're using 4 colors in a scale, bright red will mean 5% added to our margin of safety, orange will mean no change in our margin of safety, light green will mean a 5% deduction from our margin of safety, and bright green will mean a 10% deduction from our margin of safety. When our scale has 3 colors, bright red will mean 10% added to our margin of safety, orange will once again mean no change, and bright green will mean a 5% deduction from our margin of safety. First two ratios that we're going to check out are the EBIT growth and the margin growth. As you can see, the EBIT has grown from 1.2 billion in 2013 to 1.6 billion in 2021. During this period, the average growth was 4.69%, meaning in the orange part of our scale, which is no change in the margin of safety. The margin has grown from around 15% to almost 20%. During this period, the average growth in margin was just under 7%, which means way outside of our scale, so a 5% deduction in our margin of safety. The next two ratios that we'll be looking at are the dividend growth and the payout ratio. As you can see, the dividend has grown from $1.10 a share annually in 2010 to $1.48 annually per share in 2021. During this time, the average growth was 2.81%, which means a 5% increase in our margin of safety, seeing as it's under 3%. The payout ratio is currently sitting at 56.34%. This is in our orange part of the scale, so no change in margin of safety. Final two ratios that we'll be looking at are the debt to equity and the return on invested capital. As you can see, the shareholders' equity is smaller than the liabilities. This is due to negative retained earnings in the past. The ratio here is 1.52%, meaning no change in our margin of safety. The return on invested capital for Campbell's is sitting at just under 9%, which once again means no change in our margin of safety. Let's go look at the valuation models next to determine the intrinsic value of Campbell's. The first valuation model that we'll be looking at is the discounted cash flow model. I've imported the free cash flow going from 2014 to 2021. During this time, the average growth was 7.29%. Because we're calculating a lifetime expected growth of Campbell's, I've gone with 80% of the average, which is just under 6%. Using this percentage, we can determine the future free cash flow of Campbell's and determine the terminal year, using a perpetual growth rate of 3% and a discount rate of 8.5%. Summing up all of the present value of the future free cash flows, we get a sum of free cash flow of $16.5 billion. To get our equity value, we have to add the cash and equivalents and subtract the total debt. Then we get an equity value of $11.59 billion. At a discounted cash flow price per share, we just have to divide it by the shares outstanding, which is sitting at just under 300 million. Out of this model, we get a discounted cash flow price per share of $38.71. The current price of $52.61. This leaves us with a downside of $13.19, which is just above 26% downside. The second and last valuation model that we'll be using is the multiple valuation. By looking at similar companies that are related to Campbell's, look at their stock price and their earnings per share, we get an average PE in the industry. What we then have to do is to take this PE and multiply it with the earnings per share that Campbell's is generating. Then we get a fair value of $60.34. With the current price of $52.61, we get an upside of $7.73, which is just under 15% upside. Let's go look at the final overview of our valuation. Looking at our final overview, we have imported the discounted cash flow price per share and the multiple valuation. We haven't covered the discounted dividend in this valuation, since the dividend increases have been very small, which would lead to a very low price per share. Out of these two valuations, we get an average price per share of $49.53. The margin of safety we have calculated before this by using a standard margin of safety of 25%, deducting 5% for the margin growth and adding 5% for the dividend growth, which leaves us with the same margin of safety. Doing this, we get a fair value of $39.15. With our current price of $52.61, the downside is 29.39%. Even if you would remove the margin of safety completely, you would still be left with a downside of minus 5.86%. I hope you enjoyed this video. If you have any recommendations on companies that I should cover next, please let me know in the comments. Thanks for watching.